So basically, I'm going to talk about European Union and VAT taxation. And European Union is based on some core principles. Among those principles, ensuring free or fair competition on the markets and free movement of goods and services among the member states are those principles of the utmost importance. As debt and taxes are the only things inevitable in life, so at some point of time, it was necessary for the European Union to set foundations for taxation of international trade. And that's what I'm going to talk about. I can't present all the taxation rules, so I'm going to concentrate only on some VAT principles in relation to international supply of services and supply of goods. In 1993, the European Union moved forward with the creation of the single market and the abolition of controls at fiscal frontiers. Because of that, there was a necessity to create a system of VAT taxation that would prevent double taxation and distortion of the competition. This system was transitional. Why? I will provide for some explanation of that. If we think about commodity taxation, and commodities are moved from one country to another country, that of course there are two possibilities. The legislator may decide such a movement. Either it will be taxed in the country of origin, so where the producers are established and the suppliers are established, or in the country of destination where the customer resides and where the final consumption takes place. Of course, the logical option would be to tax everything in the country of origin, and that was initially the concept of the European Union. But then a discussion started, and European Union noticed that such a system based on taxation in the country of origin only would have a very negative implications. And those are partially presented on that slide. What would happen if you have taxation in the country of origin? Of course, that may trigger the tax competition. Certain countries in the European Union are economically stronger than others. Those weaker countries will definitely lose because how do you define the weak country? For instance, those are these countries with a negative trade balance. Apart from that, those weaker countries will try to subsidize or improve their own situation by increasing VAT rate, and increase of the VAT rate will have a negative implication, further negative implication for the suppliers in that particular country, because the suppliers from that country will lose competition. As you can see, if you are a supplier from a country with a lower tax rate, you have more room to set margins, you can make more profit, you can sell goods or provide services abroad, and of course you will not lose the customers. So the European Union decided that the sustainable development and justice for all the countries will be a priority, and they created a transitional system. So the system is based on a combination of the origin and destination principle, and whether origin or destination principle is applied depends on the type of transaction, so the nature of supply and the identity of the customer. And of course, creation of such a system that is a combination leads to some intricacies. So the system is pretty complicated. It must be said that transactions that are on international scale are the so-called intra-community supply of goods, importation that is taxed, and also supply of services. And for each of that transaction, European Union had to provide for a specific definition. So intra-community acquisition of goods, or that is taxed, is defined as a supply of goods between two parties, between two businessmen that are registered for VAT and don't make use of the exemption from the VAT and supply the goods between each other. One is located in one member state, the other is located in another member state. And in such a situation, a destination principle applies. In another situation, so when goods are supplied to the final customers, origin principle is applicable. Similar rule applies to importation. So importation is usually taxed in the country where the goods are located when they enter the community. But there is an exception provided for enterprises. They may use a special arrangement, meaning that taxation will take place in the last country where goods are provided. So when, for instance, there is an entrepreneur from Germany acquiring cars from the United States and they will be transported via Belgium and other European countries, normally taxation will take place in the first country, but the European Union legislator decided that it will not be the best idea, so taxation will take place in that particular case in Germany. When it comes to services, the problem is even more complicated. When we have business-to-business supply of services, taxation takes place according to the destination principle. When there is a business-to-customer supply, taxation takes place according to the origin principle. However, different services are treated differently because there are some exceptions. For instance, by intermediaries, they may be taxed according to origin principle or destination principle, depending on their role in the transaction. Different rules exist for hiring of means of transport, when there are catering and restaurant services, culture and similar. There are plenty of exceptions for that rule, and I will not go deeper into that. But the system the European Union created was a system that should ensure a sustainable development. But as a result, it is still pretty complicated. And the more complicated the system is, the more vulnerable it is towards fraud. And that turned out to be true for the European Union. As a result, fraudsters are misusing the system of intra-community transactions or intra-community taxation. And the fraud in the European Union reaches more than 90 billion euro. That was an estimation for 2020, and before it was even more. And of course, 1/4 is missing. So 1/4 of the revenue is missing because of those transitional system. VAT gap is so huge not only because of the fraud. There are some incidences of avoidance, bankruptcies, organized bankruptcies, administrative errors, and so on. Some countries are losing more, other countries are losing less. Of course, when we take the amounts in relation to the revenue, then Finland, for instance, or the northern countries are not losing a lot of money, but southern countries, Italy, for instance, or such countries like Romania, Malta, are losing more than 20% of their revenue. In nominal terms, a lot is lost also by Germany, France, and other countries. At some point of time when the UK was a part of the European Union, the loss was also tremendous for the UK, and UK was among the first countries to notice that something wrong is going on. So the European Union is trying to find out what to do to save the system of taxation, transitional taxation. And last few months, they were discussing about promoting digitalization. And they proposed the so-called VAT in a digital age. There's a program implementing a digital reporting system, invoicing, single place of registration when you supply to different member states of the European Union. And also they suggested some platforms, creation of some platforms for selected services to simplify the system. And summarizing, must be said that digitalization is not an option. It is a necessity and a prerequisite to safeguard the government's revenue in the European Union. And at the beginning, the system was thought to be transitional because countries were expected to agree on the common VAT rates. But it didn't happen, that there was a conflict, that there was no agreement on that. So there is no other choice than to strengthen the control, and digital methods may be the only way to solve the problem. Thank you very much for your attention.